Drake and Elena Stafford built Apex Precision Manufacturing brick by brick, nurturing it from a makeshift garage into a regional leader in custom industrial components. As their company flourished over 3 decades, so too did their worries over succession and the unwelcome shadow of estate taxes that threatened to diminish their life's work. By spring 2023, Apex boasted impressive revenues, a loyal client base, and a growing rumor that a large acquisition was looming. The Staffords understood that time was of the essence. With retirement on the horizon and their 2 adult children stepping into the company's leadership, they convened with their attorney in hopes of designing a transition plan that would minimize tax exposure and safeguard family wealth. They decided to act before the company's valuation could soar. Retaining an independent appraiser, they sought a fair assessment by focusing on the business's current cash flow, industry risks, and a lack of a public market for their shares. The final verdict was sobering yet strategic. A 40% equity stake was worth $10 million, a number the Staffords considered conservative, perhaps even a bargain. Without delay, Drake and Elena transferred this 40% holding into irrevocable trust for their children, utilizing $10 million of their combined lifetime gift tax exemptions. This legally froze the value of the transferred stock for future estate tax purposes. Any appreciation beyond that $10 million now belonged in a new tax universe, outside the parents' taxable estates and insulated from future estate tax liability. What followed over the next 24 months surpassed everyone's expectations. Apex Precision secured a coveted federal infrastructure contract, catapulting revenues and increasing its industry cachet. A wave of consolidations rippled through the sector, causing valuation multiples to surge. The economy proved favorable. Competitors became buyers, and the entire market seemed to hunger for the type of precision work Apex excelled at. The Stafford's children, now board members and trust beneficiaries, witnessed the transformation firsthand. Their initial 40% interest, papered at $10 million, grew in both strategic value and bottom-line worth. Board meetings turned animated as talk of a liquidity event moved from speculation to reality. Then, in the autumn of 2025, an international conglomerate extended an all-cash offer, $40 million for the company. Negotiations proceeded quickly, and by year-end, the deal closed. The mechanics of the earlier planning became bluntly clear. Because the 40% gift had been made while the company's value was still $10 million, the $6 million in appreciation escaped the estate tax entirely, avoiding a 40% hit that would have cost the family $2.4 million in estate tax liability. Instead, those savings remained in the children's trusts, compounding wealth intergenerationally. On closing, the Staffords took home $24 million for their 60% retained interest. The Children's Trust received $16 million, insulated from estate taxes as a direct result of their parents' timely planning. What might have been a straightforward inheritance became, instead, a financial triumph guided by strategic foresight and professional counsel. The true legacy, beyond the monetary windfall, was the realization that estate planning is more than document signing. It is the careful alignment of timing, valuation, and opportunity. The Staffords' gift to their children was not just wealth, but the savvy understanding of how to preserve it for generations to come.